All right, getting back into it. Basis considerations. Construction period interest paid on debt until the building is put into service must be capitalized for certain long useful life property. The book has a good example of this. Basically, if I'm building a building on this property and I need to take out like a construction loan to do that, I mean, that's obviously going to have interest tacked onto it. That gets capitalized along with that property. Homogeneous property, example stock, when specific identification is not possible, tax law requires the FIFO approach. Mutual funds can use the average cost method. So I've got a good example of this. Preparing a tax return for a client, this is probably about a year or two ago. Um, he was born in like sometime in like the mid to late 70s. He was about 10, so we're looking at mid 80s. His parents bought him about $10,000 worth of McDonald's stock. McDonald's stock was about $6 at that point in time. Um, as it went on, so you're talking 40-ish years of um, stocks being dividends being reinvested. So he gets a dividend, it gets reinvested into more stocks, and it keeps going like that for 40 years. He sold about the majority of it, not all of it, but the majority of it, and he made about $1 million on it. So it was, and because there was no specific identification, he was at a brokerage firm, he went to another one, went to another one. That gets kind of lost in the shuffle, and then it becomes, well, how much did you buy this for? No idea. We have no idea what the basis is. So we tried to go back and figure out, okay, well, what is a conservative and realistic basis for this? And it's looking back at, okay, you bought it sometime in the mid 80s. Okay, well, we think it's going to be about this, but you also reinvested some. And so let's take a look at that. And it can become very complex very quickly if you don't know what your basis is. You have to start kind of trying to make some guesstimates. Uh, and so when possible, you want to use specific identification or keep your own records as to how much you bought this for, or what was invested. Because a lot of times that can get lost over time. So cost basis calculation, you've got fair market value of the property given in exchange, shipping, installation, insurance, transit, because that's all part of it. Section 263 unicap items plus your construction loan interest, that gets you your cost basis. Property receipt as a gift. I've got another good example for this one, but we'll go through the slide first. So the donee's basis depends on the donor basis and the fair market value at transfer date. If the fair market value is greater than or equal to the donor basis, then the donee basis is the same as donor, plus a gift tax adjustment, if there is that. So if the fair market value is greater than the donor basis, then I get carryover basis from whoever was gifted. If they bought it for 20,000, it's now worth 50 and they give it to me, I get 20,000. That's my basis. I don't get the 50 because it was a gift. That works differently when you're talking about inheritance, but gift basis, you get carryover basis. If the fair market value is less than a donor basis, then a dual basis exists and the sale price determines the basis. So going back to that example, and I can't remember how much I said it was, but let's pretend that someone buys this property for 100,000 and something happens, it's now worth 50. And they gift it to me. I exist in a weird quantum state where my basis could be 100,000 or it could be 50. So it's referred to as dual basis. If I then sell that, so the sale price is less than the fair market value, the basis is fair market value and the loss is recognized. If the sale price is greater than the donor basis, then basis is the donor's basis and a gain is recognized. If the sale price is between fair market value and donor basis, then no gain or loss is recognized. So in the example that I have, it was somebody who received land from their brother. And his brother had purchased it for, I can't remember the exact numbers, but we'll say 500,000. The government placed an easement on that land, so now it's worth about 250. He gifts it to his brother. So his brother has that dual basis, right? He's got the 500,000 potentially, or he's got the 250,000 potential. He sold it for like 350,000. So he didn't, because it's between here and here, right? His basis is both 500,000 and 250,000. He sold it for an amount in between there. The IRS says, you know what? We don't know what this is going to be. So there's no gain, there's no loss, everybody's square. It's not something you see a whole lot of. I was just excited that I had an actual example. Gift basis quick check. Value is the fair market value at date of death plus tax, unless the fair market value is less than donor basis. Then you get into some calculations. Sale price is greater than donor basis. Donor basis, you recognize gain. I'm not gonna go through this, but just understand that it, depending on the transactions events and what takes place when, and what's the fair market value, you can come up with a completely different answer. Determining a donor's basis in gift property. I would just print this slide off again. I'm not going to go through all this, but we'll go through some of them. It's a fair market value of gifted property less than the donor's adjusted basis. Then you answer that question, you go no or yes. The donor pay gift tax upon transfer. Say no. Okay, then the donor carries, I get carryover basis. If it does pay gift tax, then I would get the donor's carryover basis allocated plus the gift tax paid. It's part of transferring. Okay, so property gifting. These rules prevent transferring property only to reduce taxes. If I am on a 10% tax bracket taxpayer, have stock with basis 10,000, fair market value of 1,000. What's my capital loss? It'd be 9,000. But I can only take $3,000 per year for the next 3 years. So I would save the 3,000. So my son is in the 35% tax bracket. What if I gifted it to him and he sold the stock? If his basis becomes my basis, then he's got $3,000 loss for 3 years, and we'll say 1,050 a year of taxes. So by colluding, we've avoided $2,250 of taxes. If his basis becomes fair market value, then he has no loss and no tax savings, and I lost the tax savings that I would have had. So in gifting, in general, it's good for the donor to gift appreciated property. And if it's depreciated, you want to sell it first because of the carryover basis. Allocating gift tax paid to basis where the fair market value is greater than the donor's adjusted basis. In that case, gift tax gets added to the donor's adjusted basis, and then there comes a calculation that it's gift tax paid times the fair market value at the time of the gift less the donor's adjusted basis, and that's divided by the gift less the annual. Property received from a decedent, generally the donee's basis is equal to the fair market value at that date of giver's death or alternative valuation date. That is commonly referred to as the step up in basis, which is why you don't really ever gift houses, right? It's you put it into a will or it's inherited to an heir upon death, and that really comes back to the carryover basis of a gift versus the step up in basis at the time of death. There's an exception to that. Steve died in 2010, and special rules would apply calculating basis. That's because in 2010, Congress couldn't really make up their minds as what to do with the estate tax, so there was no estate tax in 2010. If married decedent lived in a community property state, surviving spouse automatically gets a stepped up basis, his or her one half of the property as well as the decedent's one half. not gonna go into an example of that, but actually, I am gonna go into an example of that. I'm married and I bought a house with my wife and we bought it for $1 million. And at the time it was her debt, it's now worth 2 million. So it appreciated the million, but I only had one half of that, but she had the other half. So she passed away, I get her share. I'm now, I now have a basis in this house of 2 million. Inherited property basis, fair market value at the date of death, or the alternative valuation date, that's 6 months from the date of death, the sale date. You have to file a estate tax return to claim the alternate valuation date, otherwise it's the executor can elect either date, but applies to all assets of the estate unless an asset is sold registered prior to it. In the holding period, it's always long term. So here we've got an example, gift portion, gift tax adjustment to be added to the donating basis. This, just get back into the rules behind it all. Gift cash, the tax fund considerations, gift cash in order to save on estate taxes, decision making influenced by the animal exclusion. That's, I think, 18,000 for 2024 now, to avoid estate tax death. Given now rather than save later. Selection of property to transfer. Highly appreciated property should be retained until death. That's because, again, you get that step up in basis. Lost property should be sold before death, so the taxpayer can recognize the loss only if it's business property investment. If you gift it, then no one gets to recognize the loss. And that's why it's better to sell it and you recognize the loss, and then you can gift out the proceeds from it. So let's go back to the example of a house, right? My dad bought a house for $100,000. He passed away, and it's now got a fair market value of $500,000. If you were to gift that to me, okay, my basis is 100,000, got a fair market value of 500,000, and I sell it. Okay, I got a recognized gain of 400,000. If he were to, if I were to inherit it from his death, okay, my basis is now $500,000. I sell it for $500,000. I don't recognize anything. So that's why this highly appreciated property, you want to have an heir inherit it because you get that step up. I'm going to stop this video here and we will get back into it in video 3.